The US dollar has entered a bearish trend. Is it going to continue, guys? Ken Chigbo back with another E8 Markets fundamental update. Let's jump straight into this. So the US dollar has entered a bearish trend. It has been falling now for 2 consecutive weeks. If you take a look at my screen here, as you can see, we actually shaped up for a bit of a reversal here a couple of weeks ago with this reversal doji candlestick, which was validated with that big selling the week before last. Now, this selling here this week was because Jerome Powell was speaking, all right? He was testifying and he was gearing the markets up essentially for potential rate cuts, okay? Markets were reading in between the lines. He essentially said we've made substantial progress on inflation coming down. Obviously, there's still a little bit more work to do, but substantial progress. So markets were reading between the lines there and thinking, look, a September rate cut is coming. So we had some big selling there for dollar. In addition to last week as well, the data wasn't the best, of course. When you look on the week before last, excuse me, that week, we had softening in the labor market picture. When you look here, average earnings came down to 0.3%. The unemployment rate ticked high to 4.1%, which is all disinflationary. If the labor market is getting worse or is weakening, right? We've got less people potentially in the workforce getting paid decent money. If we've got less of those people, then there's less stimulating in the economy, less spending. And of course, if there's less spending, price of goods and services is going to come down. That's disinflationary, right? So that was that week. Now this week here, if you look, big downside pressure, and the focus was on inflation, right? CPI data cooling largely across the board there, as you can see. Okay, and this really is gearing the FOMC now for potential rate cuts. They're getting closer and closer towards their target. Remember, they want inflation on an annualized level down at around the 2% level, and we're heading in the right direction. Now, markets are taking that with both hands and largely pricing in the potential rate cut for September. Look at that, 96.2% chance now. Before this data, before the CPI data, we had a probability of around 74, 75%. Now it's jumped up to 96.2%. So really gearing up for potential rate cut. Now, if we look at the dollar index, right? As I explained last week, this was make or break, and we've cleared this big, heavy support area, which is this trend line had been supporting the price since the commence of 2024. This is significant, guys. Okay. Now, the dollar has lost its edge in some sense as we get closer towards rate cuts on par with other major central banks that have started to cut rates. So this clear zone here, this is a major zone, as you can see, around this sort of 104.30 area. We can see we're trying to penetrate this to the downside. If we do, it really does open the door for a potential fall down towards this 103 zone. Okay, we haven't been here since March, and it could really allow those dollar peers, which are capitalizing at the moment, the likes of Euro, GU, Aussie, so on and so forth, to really continue to push to the upside. In terms of dollar this week, we'll just keep an eye on retail sales data to see if we get a further reinforcement of softening of economic data. Also worth of note, Empire Manufacturing Index. I don't expect Powell to say anything different from what he has. And then, of course, the weekly unemployment claims. This week, attention will also be on the euro because we do have the ECB, the European Central Bank rate decision, where they're expected to keep rates, as you can see here, unchanged at 4.25%. That is largely expected because the ECB right now remain divided as to whether more cuts should come or whether they should hold. Okay, and when typically we have a divided central bank, we're not likely to get any action until we move towards a more unanimous decision. And one of the reasons for this as well is, at the end of the day, if we look at Euro CPI, it remains sticky here. Last read, as you can see, 2.5%. The read before that was higher at 2.6%. It's still sticky. We're not seeing a smooth road towards the ECB's target, which is down at around a 2% mark. So they're likely to still sit on their hands until inflation comes down further. Because remember, we need to keep rates higher for longer in order for inflation to come down. Now, with euro, as you can see, it's taking advantage, obviously, at the moment of this weaker dollar. We're pushing to the upside here for 1, 2, 3 consecutive weeks. We've cleared a bit of weekly resistance here at around this sort of head into the psychological 109 area. And we've almost formed a bit of a W here. You could view this as a bit of a W. Bam, bam, bam. And a neckline here at 109. Oh, went a bit off there. The neckline here around 109, which we obviously breaking out, could retest and obviously could really rally to the upside towards that sort of psychological 110 mark. Also, the fact that we've broken out of this descending flag structure, this descending channel, really leaves the door open for the bulls to potentially capitalize on this, so long as we get a further pushback this week from the ECB with regards to any incoming rate cuts. Now on to GBP, which has been an outperformer within the FX markets. The reason being is we've had obviously the UK government, new government coming into play, the Labour Party, which have sparked a lot of optimism because they're expected to really boost the economy again. We've also had pushback from a couple of Bank of England members with regards to imminent rate cuts, because markets have been trying to price in August rate cuts, but the Bank of England are like, look, inflation's still high. A couple of members have been saying that. Wages are still high, which of course is inflationary as well. And then obviously last week as well, if we look at the calendar here, we had good GDP data from the UK, smashing expectations. So there's a number of things that are supporting the pound to the upside. As you can see, right now we've been on a massive rally. As I said, the best performer really within the FX markets. Now, if we take a look this week, we're going to keep an eye on CPI, which is expected to cool around 1.9%. The core expected to remain sticky at 3.5%. One of the worries for the Bank of England is average earnings, which is expected to cool this time to 5.7%. Now, we will keep an eye, and retail sales, okay? This is important as well. So all of these figures, okay, if they start to show cooling in CPI, cooling in earnings, a tick higher in the amount of people claiming unemployment benefits, retail sales cooling, then that's really going to set the pound up for a potential reversal. If we take a look here, technically, obviously we've been on a massive run. I mean, you could argue that, look, we've been pushing to the upside. We are a little bit overbought, but right now the momentum is well and truly with the pound. You can see the way we broke out this wedge, extending to the upside. When you look at the higher time frame, really, this is the next major area of supply, heading into 130.50 towards 131.00. The amount of times we've hit that, but also just keep in mind the psychological 130 mark could prove to provide a little bit of resistance because it's a big psychological number. We've faced resistance there before in the past. Look here, look, we came all the way down to 127.50 before pushing to the upside. We saw it again. We've seen it numerous times, okay? So if we could break down 130, then we're going to have a nice run in towards this 131 figure. But obviously, we've got all these key data points in the way, so you're going to really need to watch this, guys. Fingers on the pulse. So there are a few other events on the calendar, but we're just sticking with some of the key talking points right now. Plenty of volatility once again in this latest week. I hope you have an amazing and blessed week, and I'll see you on the next update.